Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com, and I'm going to take a technical look at some of our major currency pairs after the much weaker than expected non-farm payroll report. So let's get started. First, let's look at the euro versus US dollar. And as an educational point here, remember that 114 or 112.14 to 18 level. That was a key level for us. It's been a key level going back a long ways. Why? Because we had some support there, and then we had some resistance against it once we broke through that level. And in today's trading before the non-farm payroll, I said if we get above that 112.14 to 18 level, that's going to be more bullish for this currency pair. And you can see what happened against that level off the 1 minute chart. If I go to the 1 minute chart and take a look at or outline this 14 to 18 level, what do you notice here? What happened in the first minute after the non-farm payroll? The market went up. We went up to the 26 level, and the important thing is to recognize what this low was. This low from the 26 came down to 112.18, and that's where traders had the opportunity to get in against that low risk area right here around the 14 level. Maybe you put your stop at 112.12 because the number was just so weak. But even if you bought here at the 36 or so level, your stop would be down here, right here, with the expectations that we're above this 14 to 18 level. That's bullish. That should take the price higher. So if you have a lesson in trading here today, it is believe your levels, trust your levels, understand that the 14 to 18 level is a key level. We've talked about it for a while now, and the ability to hold that level was an exercise in trust. You need to trust those levels. So what happened? The market moved sharply to the upside, and there is another key level that we have to pay attention to, and this is closer to where we trade right now, and a level that I'm going to consider a risk-defining level for traders going forward, and that comes in around the 113 level. And to understand the 113 level, you need to go to the 4-hour chart, and if you take a look at the 4-hour chart and look at the retracement of the move down from this high to this low, that the 38.2% retracement comes in at the 112.95 level. In addition to that, we have this green line. This green line represents the 200 bar moving average on the 4-hour chart. And so we had both the 38.2% retracement and the 200 bar moving average at the same level. That makes it a key support level. And if we go back to our 1 minute chart and we take a look at that area or that level, what do we see? We see that the market came down toward it. Here's the 113 level. It's now the 50% of this move to the upside. But the 113 level came down to around the 113.02 level, and we found buyers against that level. We got an extra boost from the ISM data, which came out much weaker than expected, and we moved up to a high price of 113.49. All right, and since that time, we've consolidated. It's Friday. We're heading into the close, heading into the weekend. But going forward, what do we have to look forward to? Well, we have to look forward to holding support against the 113 level. As long as we hold support against that 113 level, the potential exists for the market to continue to go higher. Now, we may go below that level in early next week's trading, but if the 112.14 to 18 level was a key level, the 113 level is another key level. That's going to remain a key level going forward. So if we do go below it early next week and then move back above it, that's going to be a key level, a level that's going to dictate our trading in next week. But for the time being, traders who are long above the 113 level or long, long here, risk is the 113 level. There's no doubt about it in my mind that is the risk for trade. Now, why is the market stalling at the 49 level? And to understand that, you need to go, you can go to the daily chart here. I'm going to put it on the daily chart. And if you look at the daily chart here for the euro and going forward, where we may be going here for this euro, the 50% retracement of this move down from the high to the low comes in at the 113.56. Our hard price today, 113.49, just about 6 or 7 pips away from that level, and so we are finding some profit taking into the weekend against that level. Keep that level in mind in next week's trading. If we should go above that 113.56 level, we have the potential to move higher in in this currency pair, and then we'll start be looking toward just on a longer term perspective, this 114.35 to 65 level. If you recall, all these swing highs stopped near in that area and led to big sharp moves to the downside here. And so we'd expect that this area right through here is going to be a key resistance area. If I were to draw the story or tell the story about what the euro versus US dollar is going to do, it's going to hold the 113 level. It's going to move up through the 50% retracement level, and it's going to move up to this level right here around the 114.35 to 65 level, and find sellers against that level just because, okay, with stops above, just because it's a key level. It's a key level up there. So that's how I would think that the market would go going forward. I don't know if it's going to or not, but we're going to just pay attention to our levels and let the market tell us. Not me. I'm going to let the market tell us what the price should do. Right? That's all we should do. That's all I'm going to do. Let's take a look at the dollar versus yen. Now, this currency pair is interesting. It's kind of in nowhere's land here for me. Yes, we're bearish. We move sharply to the downside. We move below these lows. This is a 4-hour chart of this currency pair, and we have lows here. We have a low here, and then we start to use that area as highs. Okay, and so we went below that level. And a little clue right here, the market went below it, came up to that top side around the 62 level, and then sold off to the downside. Now, the thing about this currency pair is that that we're in this extreme area, this recent extreme area where the price moved below the yellow area and created this kind of extreme where we had a moved down to the extreme low, and then we had a low that corresponded with this low, and we started to move higher. You can see that happening, and we're sort of in between this risk area up here and this target area down here. So would I do anything right here as a trade? No. This doesn't make sense to do a trade right here because your risk on a short is a move above here, and your risk on a long is a move below. I don't know. The risk reward is simply 50-50, and so I wouldn't do anything. But on a retracement up to this area, I could expect that we might see some sellers against this area right here, and on a move to the downside, maybe there's some buyers of some profit taking there, but the bias is definitely to the downside. So think in terms of selling the dollar versus yen versus buying it. Don't know if it's going to necessarily work, of course, but risk can be defined and risk can be limited against those levels. Now, let's take a look at the sterling versus US dollar next. And this is an interesting currency pair as well. Why? Because we do have the Brexit vote coming up, and that's going to have an influence on this currency pair. And so we did see the sterling versus US dollar rise in sympathy with the US dollar's weakness, but we did find resistance near, and this is close enough in horseshoes and hand grenades in a market that's this volatile today, near the 200 bar moving average or 200 hour moving average here at around the 145.72. I would expect that this market is going to find ceiling against this level, or traders selling against that level if the market should continue to go to the upside. Now, on the downside, traders who sold against here have an interesting support level down here against the 100 hour moving average. That's the blue line in the chart. You can see that we went from the 200 all the way down to the 100. We're trading in between what I call the goalposts defined by the 200 hour moving average, 100 hour moving average in this case, and that's going to be our trading range for the sterling versus US dollar until the price moves outside of that range. I would be more inclined to think that the chances are of something like that for this currency pair, only because the Brexit, but saying that these polls can come out and they can go either way, and we can have a poll that says that that it's moving more toward a no, and we can see the pound sterling move up to this area right here. But I would expect that that there would be sellers up here. And you can also argue that you'd see buyers here and ping pong between the support and the resistance in the sterling versus US dollar. So that's a look at the three major currency pairs here as we head into the weekend. I hope you gathered some information about what had happened, also what technical levels are in play, what we can expect going forward, what target levels, and so on and so forth, and where your risk is, most importantly, for trading in these currency pairs. If you like this video, give me a thumbs up. If you don't like it, give me a thumbs down. Always, if you haven't subscribed to our email list, click the button at the bottom of this post. Good fortune with your trading. My name is Greg Michalowski. Have a great weekend, too. Bye-bye now.